Are we on?
Yeah, we're on. Just stop and open it.
Refresh it.
No, just closing it.
So can you bring up a just a little banner talking about who we have on?
Okay.
And I tweeted that out. We'll probably get another tweet right when we're
I'm going to
upcoming interview 12:30. All right, Rob Richards here. So Gas, if you're out there, Earth calling Gas. We're standing by here, and we're just getting ready for an interview here, and looking forward to this interview. Looking forward to it. All right, so I'm going to give Gas. I'll give you a call, Gas. Let me give him a call. All right, here we go. How you doing, Jim?
I'm good, John. How are you?
Good. There we go. I just want to get the volumes high, or not too high. I want to make sure everything's good. Good to talk to you. I'm looking forward to this. Is your friend Rob there?
Yeah, hi. How you guys doing?
Hey, Rob. Good to meet you.
Likewise.
We got a small echo. Is it on your end?
Let me double check that.
I thought I turned everything off.
Let me double check that. No, there shouldn't be any echo on my end.
Okay. Well, let's go forward then.
All right, good. So yeah, I do hear it in the background. You want to try calling me on Skype just to see if it gets rid of it? If you still have it?
You want me to call you?
It might get rid of the echo on your side. I'm not sure.
So right now it sounds good.
Let's go with it.
All right.
All right. So we got Jim here. You know him as Gas, and Rob. Right? Rob Richards.
Yes.
Rob Richards. You get lost in that name.
Yeah. Not really.
Is it Robert?
Robert, whatever.
Yeah. I have a brother and a dad named Robert. So.
Well,
So be it.
So we'll just get a little background of Rob. Rob, you are a market maker. I guess you're involved in the stock exchange in some way.
I've been involved in making markets in the stock exchange since 1994. So, from the time when it was mostly manual to now, which is pretty much the market's mostly automated. Market making isn't really what it used to be, but we still assist other firms and institutions in executing, although it's on less and less of a occurrence because of the automation of the markets. I wanted to come by and talk to Jim because he calls me out of the blue sometimes asking me about different prints and time and sales.
Yeah.
So I told him I could maybe shed some light on it for him.
Yeah, I think you can shed light on a lot of people. For me too. I mean, it's something that we've never really get to hear from a person like yourself who's involved in doing it, the process,
Right.
And that's a great resource there. So we appreciate it. I mean, you were trading back in '96 or involved in this process. How? And you say it's not as it's just not like it was back then. Is this the age of, is it eventually going to die out altogether, market makers? And could you explain what a market maker is?
Market maker used to be, back in the 90s, you had stocks. Every stock had a bigger spread, so you'd have like NASDAQ stocks that had 50-cent spread. Market maker would be there to buy and sell stock at their quote, and they'd have to honor whatever the quote there was. And it's still, that part of it is still the same. It's just that market makers now are more or less spread out, and there's a lot more fragmentation. There's obviously a lot more market participants, and exchanges are now also acting as market makers. There's a bid ask on both sides. They're providing liquidity. So a majority of the volume is obviously going through the exchanges. So market makers step in here and there for different reasons.
Yeah.
I can't speak for all of them, but some of it is proprietary trading. Some of it is execution for customers. But it used to be back in the 90s that market makers were was the end point for all executions, basically, in the equities markets. So that at least in NASDAQ,
Yeah.
the New York had the specialist. system. So.
Wow, and then things have changed over the years. I mean, it's been a long time, and I've noticed. I mean, you still say that the process continues, but it's more automated. It's more of there's just more. It's more liquid trading. Not as the spreads are tighter.
Yeah, well, the spreads are tighter. More people have access to the markets than ever before. Like people like I'm looking at Jim here trading. That wasn't the case 20 years ago. And actually, some of the functionality that people have at home is just as good as the professionals have, and that's kind of even the market out. And institutions have their own ways of executing. They still use brokers, more or less, though, as a payment for commissions for services than for flat out execution. Although they still use some brokers offer some bigger brokers offer both. They offer research, but they also offer execution services, like a Goldman Sachs. They have their research side. They get paid commissions, and sometimes it's in the form of securities execution. And then they also have an execution side of their business, which is a high volume, all-in type business for strictly on execution for volume customers. So.
Well, we can really get down and dirty into this stuff. You mentioned that you were going to, Jim actually mentioned order flow to us today, and
well, John, maybe.
I was going to say maybe you want to just jump in here, Jim, and get.
Well, Rob was explaining to me, at some point was, his business involved institutions coming to him and saying, we want to sell 100,000 shares of, XYZ, and he would execute it, throughout the market session.
Yeah.
And would get a better price than maybe, these mutual funds, a lot of times they have a meeting in the morning and they just dump shares on the market.
Yeah.
They don't get a good price, right?
Well, there's questions I want to ask about that. Like, that whole process where there would be a big order coming in and they could drop that price, they could drop that order in stages, and you're selling your stock at certain stages, the same thing, buying it up. The people behind the scenes, there must be a way of profiting on this. Is there a big for what Robert knows, what he knows of the back end of how things work? Can he take advantage of that knowledge and actually trade today's market?
Well, I mean, if you're reading the tape, sometimes if you see a stock tick down a percentage amount and then you see a big print, I mean, I'm sure anyone that's read the tape would know that that's probably a short-term buying opportunity. To see that when it's actually happening, it's hard to say, because nowadays a lot of institutions are using algos and they're breaking up their orders. They're not really coming into the market. When they execute, they want minimal market impacts. They try to look at a transaction cost analysis, which is basically a breakdown of, if they move stock at a certain price, what's the price? If they move a certain amount of stock in a certain range, what's the price differential going to be for the execution?
Yes.
So there's all these metrics they use now. So it's not really like it used to be. Occasionally, you will see big prints go off above and below the market. I mean, and there'll be a certain modifier on them. It could be like a .w for an institution that's working a large order for somebody, a broker-dealer or an institution working a large order for somebody, and they give them a negotiated price. You could also see a derivative. You could also see like a lot of derivatively priced executions for options that are in the money, but the stock price is at a different price. You might see a big print below the market for someone exercising a put or a call if the stock's up. So those are just the different things that happen. There's no way to really know it's going on when it's going on unless you're just reading the tape. So
John, maybe this is a good segue into explain order imbalances at the end of the day, because that's where Rob was actually giving me a good lesson.
Excellent. Everything is going to work today.
Okay, so order imbalances work, and it's ever changing. It used to be, you would put orders in. You could put them in at any time of the day. This is for market on close, and market on close was an auction on the New York. It was basically the specialist would match orders at the end of the day, and sometimes you'll see a big print go off way outside the market. You see it less and less now, as most of the exchanges are moving to a Dutch auction at the close. But
time out, Rob. Explain Dutch auction for everybody.
It's just pairing up buyers and sellers and taking the best price available to both sides. So
is that like a Dutch date?
Yeah.
yeah. But now, so some people will see on the tape, an order imbalance, sell, Citigroup, 300,000 shares. It's basically telling people that they will no longer accept sell orders because there's an imbalance for the market on close, and it's also giving buyers an opportunity to get out, and also for people that have put their orders in for market on close. Past a certain time, they can't get out unless there's an imbalance on the same side. So if you put in a sell...
So wait, time out. Explain that exactly, because what you were telling me is once your order's in, it's stuck unless you're on which side?
If you put in a sell order for market on close, and it's on the New York Stock Exchange, after 3:45, you can't get out of that sell market on close
unless what?
Unless they say there's a sell imbalance. Then any sellers that want to get out of their market on close can get out, and so that gives them the out. And so it's telling, basically, they're not accepting any more sell orders for market on close, and they're also giving people that do have a market on close order the availability to know that there might be market impact on their execution, and they can cancel it maybe for another day.
All right. So what can we profit on that information? Because it comes out before the close.
This is excuse me, let me just cut in. This is something we see a lot with Mr. Top Step. They put Danny Riley up in the CME, and they post an order imbalance, or basically the imbalance on the overall market. Yeah, so I'm just going to say that we are familiar seeing that order imbalance come in, but so many times we've seen it like a large sell imbalance, and the market takes off, or how does that whole process work, and why is it just not a standard like sell imbalance means sell?
Well, because it's really for the closing print. No one really knows how much is paired off. I mean, except the floor. So it's basically an indication for people. It's an indication for the people that are using the market on close. It's letting them know that there's a sell imbalance. And yes, it doesn't mean that the stock's going to close lower. Sometimes it closes higher, even with the sell imbalance. It just there's all kinds of intricacies that go on in the market, and that could trigger a buy-in. Who knows? But anyway, it's letting people know when you see that flash up there. It's letting people know that if you're in past the cutoff time, you can get out if you're a seller, and it's also letting people know that that there's an imbalance.
Great. What about any more, Jim, on that, on the imbalance thing? So when we get those prints, it really...
I have noticed that a lot of newer traders will see a big print come across, after 4 p.m.
Yeah.
And they say, wow, look at that, a big block just traded. Well, that block really didn't just trade.
Well, it depends on the modifier, but usually you'll see a closing print modifier on it. Usually on the New York Stock Exchange, it's within the first 2 minutes of the close, and it'll show, and you'll see a big print. People will say, 500,000 shares of Coke went up, or 500,000 shares of GE went up, and and it's usually not an even number, but a lot of times it's the closing cross on the exchange.
So Rob, roughly, I mean, is there any rule of thumb where you say, well, the closing print, that size, that big order that shows up is, 1% of the daily market, or is it 10%, or does it depend on the stock?
It just depends on the stock and the customers and who's trying to execute at that time. There's no pattern to it.
All right. So I guess my point is that for people that look at time and sales, you can't look at that one big print and say, oh wow, look, this just happened. It really developed over the entire session.
Yeah, for market on close, for closing prints, it's people use a strategy for all different kinds of reasons. I mean, you can imagine it could be derivatives. It could just be that they want to sell. They want the closing print. It happens. And so when they put the orders in, they're guaranteed the closing print, and then they try to pair off both sides and do an auction in an orderly fashion. Sometimes there's an imbalance and it affects it, and it's outside the price, but most of the times now the closing prints are pretty close to where the market would close on the inside.
Nice. Getting back to the late prints, I do, when we see those time and sales and stuff, I'm trying to think of some of we did have a couple emails coming in, but I want to continue the discussion.
John, let me just make one point about one thing I do with time and sales, and I'm not sure if it's right or wrong. I'm going to ask Rob.
Yeah.
I set sometimes my time and sales to be greater than 100 shares, or whether it's, you know, the futures, maybe 5 or 10 contracts. If somebody comes into the market, let's say they want to sell 1,000 of Apple, and it gets taken at 1,000, that prints as a 1,000 share trade. But what if 10 people come in and buy 100? Does that print as 10 separate trades at 100? And is there anything to be gleaned from that?
Well, the thing is from that is that if a customer comes in to buy 100, they're not grouped in with other customers. They'll get a 100 share print. And nowadays, I think there's even prints below 100 shares. So, but you have to understand too, when you're watching the tape nowadays, is that institutions and algorithms too, they know, like for instance a TWAP, which is a time weighted average price order, which is an all day order that people might splice over time. So if you have 10,000 shares and you divide it by the, you know, if you want to, however the algorithm does it, but say it's every 10 minutes of the day, it might buy, you know, 50 shares, whatever the equation ends up to be. There's all that going on too. So it's harder and harder to read the tape because the algorithms know that traders will trade against the tape. So they will specifically split up the orders to protect their customer pricing throughout the day. And then when you enter in the high frequency traders, you know, with their market fragmentation too, it's harder and harder to read the tape, and everyone's trying to create as minimal market impact as possible. They don't really want big prints hitting the tape anymore because it kind of shows what they're doing. So a lot of trading is disguised, and then when you mix in retail, which is natural small investors buying small shares, it's really hard to decipher sometimes really what's going on. And then you'll see a big print, you know, outside the market and be like, what was that? You know, and that was maybe an institution that had been working for somebody else, or maybe they could have negotiated a price, or there could be a reason that print's outside the market, and they usually have to put a modifier on the tape, and that's why it's getting harder and harder to read the tape. So.
Well, this is great information. We have Gas and Rob Richards here, and Rob has been trading the markets and been a market maker back since 1996, and there's so many questions that I could ask you, Rob, and I hope you could let me get through some of these because they might be silly questions, they might be stupid questions, but you know, to be able to talk to someone who has, like, you know, kind of the experience you have, I'm just curious to hear some of your answers. And the first question I was going to ask you is that this morning I was actually watching Liberty Media, LBTYA, and I was noticed in the pre-market that there was about 2,000 trades, 2,000 shares traded in the pre-market, and the spread was it Liberty Media? Let me double check here what I was talking about. I think it was traded. Yeah, it was traded at $43. I want to see if I can actually go back to pre-market. Yeah, here's the pre-market trade here, and it was just a few thousand shares up here, but the spread was wide. It was like 42.50 to 43, but people were buying it at 43. They weren't trying to split the spread or anything. They were just picking up this stock at $43, and it was a few thousand shares. It was light volume, but I was wondering, why are people just, you know, not hitting the ask on this?
You mean taking the ask?
Taking the ask.
You know, I don't know.
And from seeing that, then we saw a tremendous volume come in. So there was, all right, I was just wondering, is there anything that you look for, being an experienced market maker, in the morning that tells you that a stock is going to run? Is there any tricks of the trade that you could look back in your 20 years experience in market making that kind of gives you a little edge on one strategy that helps you trade the market? And do you trade the market with your experience, or do you work as a market maker?
Presently, I'm where I'm working now. I'm getting things going. So today I wasn't even trading. But you know, to answer your question, I don't know. Like, if you're trading pre-market, I mean, certain stocks, if you look at them and you know the ones that, and certain stocks will trade a certain amount of volume pre-market all the time, and certain stocks will never trade pre-market. I don't know what Liberty does, you know, pre-market usually.
Yeah.
But you know, the biggest indication for anybody really, whether you're a market maker or not, is volume. You know, is there a certain amount of volume? Is it real volume? You know, I mean, is it dollar amount volume? Is it just one order? Sometimes someone could come in short a stock by accident, and they should just pay the offer to just cover their position and be done with it. Or sometimes, you know, if you see some real volume coming into a stock, then obviously there's something going on. It could be some type of news that you don't know about, or there could be someone has a big order and they're trying to get ahead for their customer. There's varying different reasons, but definitely, you know,
volume.
A spike in volume, whether it's intraday or or before the market is always an indication that there's going to be activity in the stock.
Yeah, and
you know, downside.
Yeah. No, I figured that, but I was just wondering, because we do have that, when we talk about market makers, pre-market, it doesn't exist, right? I mean, it's really, it's like an open market. I call it the Wild West. I mean, you have usually a big spread, and you have the option to actually put in your price in. You could go for the ask, but and these people were going for the ask. It was interesting, and I did notice the run afterwards, and I was just, again, just excuse me, trying to maybe try to pick your brain for, like, all right, so you're now, you do some trading, you have the experience, you've been in the back end of the market kind of, you know how the internals work real well. Is there an edge? Is there something that you could provide your son is growing up, he's 16 years old and says, Dad, help me out, I want to trade. What's the first thing you can tell me?
He has a son. He's got a daughter who's, I don't know, a champion volleyball player. She's maybe 5'2", 90 pounds. I don't know how that works, but
5'8".
She's 5'8". That's a big difference, guys.
She's petite as hell, but I don't know how she's a
5'8" is not
player,
petite.
Jim's getting old. She's 5'8". All right, from my standpoint,
yeah,
trading has entered a whole new realm where I was saying to you before, people, you guys are actually sitting there with the same technology that we have.
Yeah.
It didn't used to be that way. When I first started trading, with the big spreads, we had inat, we had things that the retail investor didn't have access to. So now, if I was going to tell my son to get into a business, market making is obviously a dying business.
Yeah.
It's moving sideways. Automation is key. The algorithms are winning. The quant guys are winning. And it makes sense that the market's moving in that direction. It's becoming less manual. I mean, the market, not just on trading, in every capacity, the equities market is moving to total automation, back office, front office, everything. So I wouldn't necessarily tell my son to get into market making.
No, of course not.
But finance as a whole is just a great business to be in, because there's so many different avenues you can go down. You don't have to be in trading. It's a very broad sector. So like Jim's sitting here trading futures. I've never even traded futures, and he's, and I'm looking at his charts and what he's doing, and
mm-hmm.
I understand how to read tape, but like I said, I've never traded a future before. So Jim, being a non-professional, is probably more astute at a lot of things than I am as a professional.
Gotcha.
So,
I got a great.
That's a great segue, because Rob's doing some personal finance advising now.
I'm not doing that. No, I'm still just trading. Sorry, no. I'm not doing.
If you're gonna do it,
both of you this question: is there any insurance products out there where you can pick your own stocks, self-directed investment? Because I think that would fit into a lot of our members, wheelhouse, because they don't necessarily want to just get into an insurance product with deferred earnings with just mutual fund picks, right? Are there products out there where you can actually pick your own stocks?
I don't understand the question.
Yeah, what type of product?
What I mean is that wouldn't it be nice to, instead of trading with a taxable account with your own picks, if you could do it in a deferred account through an annuity?
Oh, interesting.
Yeah,
well, I think you only pick the
I
baskets.
Heard it's rare. That's
the baskets of stocks, right? The IRAs.
Yeah, that's a little above my pay grade.
Okay, Obama.
Because we're getting into taxable.
That's a good one,
I'm not
Rob.
a specialist in that.
That's a good one. Hey, I got a good question in the room, Rob. Can market makers actually see our stops, or is it just algos that know where stops are set? You know what to do. You know what we're talking about. It's just you always put down a level, and you see that the market sometimes comes and takes out that level, and then moves right back up. Explain that situation. What's your views on that?
It's funny how that works, right?
Yeah.
Because it happens to us too. I don't know. I can only guesstimate. Market makers can only see what's on their book. So in the old days, if an order went to like a market maker, okay, before exchanges and ECNs and all these electronic ways of accessing, market makers could use their book to trade off of, so they could see buy orders all the way down their book, and they would know they could be long a certain amount, and they could use your buy as their stop, on the long side. nowadays it's so automated. I don't know if that's market makers or high frequency guys or what that sniff orders out. Now I'm just taking a guess here, and I don't know. I have put large orders in the market before, below the market, and I've seen a little bit of activity. So I think there is some type of filter on the high frequency guys where they can see, like, or they can see liquidity on their book. But you have to remember too, like the New York Stock Exchange still has specialists. So if an order is being routed to them, they can still see. They still see the depth of the book on there, and other people can see that too. So someone may be using your stop. If someone's using the same strategy, someone may be using your stop, to fill themselves as well.
Well, that brings us to a perfect segue, as Jim would say. When you talk about the same strategy, and when you talked about algorithms taking over these, algorithms are so much a big thing in the markets these days. High frequency traders, algorithms. What is your, and again, do algorithms all kind of, have you seen an algorithm and what an algorithm focuses on? Are they focusing on, are they so complex, or are so basic where they come down to trend lines and pick it up, or is there certain out there, someone wanted to mention the VWAP levels and the volume average levels, the volume profile. Do you get a feel of where these algorithms are keying in on the market? What are they using for their algorithms? I know it's a crazy open-ended question, but is there any, you hear about algorithms so much, but what are these algorithms actually doing? Are they what levels are they finding?
Well, an algorithm is, like you said, is a broad term. So if you say algorithm, what does it mean?
Yeah.
In trading terms, to me, what it means is that it's something. It's like autopilot. You can put parameters on an order and let an algo trade it for you. So, you could say, hey, I want to try to be the VWAP of the stock, and the algo will look at the historical volume of the stock and basically they'll basically TWAP the order for the day. That's how they work. And if you TWAP an order, a lot of times you'd be surprised how often you are very close to the VWAP. And TWAP is time slicing an order and taking it in fragments. So if you want to buy, like I said earlier, 10,000 shares, whatever that breakdown is, whatever the algo figures that out to be in a day based on what they think the volume is going to be, and the price movement of the stock. So it'll sit there and trade 50 share lots, 75 share lots when they see when they think that they're building a VWAP for that'll be as close to the VWAP as possible. And a lot of times they're pretty accurate, except on obviously volatile days, where if you look at not to get too much off the subject, but anyway, if you look at like days like back in like 2007 and 2008, you could have a day where the market's moving flat, the algos is attaining the VWAP price, and then all of a sudden the market drops 500 points. Now, if you're a buyer on that day, you're not going to be too happy with your VWAP, based on what happened at the end of the day. So, because the market fell so much so quickly, and it's based on volume too. But really, algos, what they do, where they come into play, the difference between algos and high frequencies is algos is usually working for a customer, working for a type of order that they want, and high frequency is usually just a way of trading the market, splicing proprietarily all day long. For an algo, there's usually a customer on the other side of the trade that's asking that their order to be worked a certain way, or leaving them on a desk and leaving the desk up to their discretion on how they should work the order.
Mm-hmm.
So let me ask you this question though: these high frequency trades, they shave. I hear fractions of pennies. Well, when I execute a trade, I pay a SEC fee of 12 cents or something. How do they get around that?
They pay the fee. They pay
so
an SEC fee.
You pay 12 cents whether you trade 100 shares or 1,000,000 shares?
The SEC fee is very minimal. It's I forget what it is. It's like it's very, but that's all factored into the price of their system. So they have to pay the SEC fee as well. They're not getting around that. They're trading so much volume that they make half pennies on billions of shares, and that's basically or millions of shares. So
I love it.
So it adds up for them, and they and that's their model.
Well,
So
I've heard at times that we're talking sometimes 70 or 80% of the volume is that high frequency stuff going on.
I've heard that too. I don't know how they come to that number, but that's between high frequency and algos. That they're saying it's 60 to 70%, sometimes as high as 80% of the market right now.
All right. Well, that's Rob. Let me ask you another question. I have these questions myself. What's your I mean, being involved in the markets and stuff, what's your outlook on the markets? I mean, I know everyone has a different opinion on what's going on, but we even talk about what you're a trader, you trade. Do you have a position on the markets? Do you like how the markets are trading? Do you feel the markets are extended? Do you feel, how do you trade these markets?
I mean, if any trader's looking at the market right now, what are three out of four traders will tell you? It's overpriced, right?
Yeah.
So sometimes in my opinion, sometimes the easier the trade looks isn't always the best trade.
No.
So you've had these people for years saying the market's overpriced, and they've been shorting the market and they've been losing, and eventually they'll be right. But the question is I always use this example when I talk to people. When I got in the market in the 90s, you didn't really, aside from Greenspan and some of the speeches he gave and interest rates, you really didn't. What the government was doing really didn't affect the market that much. I think nowadays, this is my opinion, and I could be wrong, but I think now the government and the market are more intertwined than ever. And I think people look at what the government's doing as what the market's doing. And I think when I got in the market, they were more separated. So I think with that in mind, I think the market is doing what it's supposed to do right now. I mean, it's obviously outperforming, but like I said, I knew people that were starting to short when the Dow was at 12,000. So and eventually, you think they'll be right, but I have no idea. To be honest with you.
Yeah, no.
There is a hedge fund guy. I think his name is Samuelson. I could be wrong, but I forget his name exactly. But he actually has a mutual fund, a hedge fund that only trades when Congress is out of session.
Well, that's interesting.
Yeah,
that's interesting.
He found that the market underperforms when Congress is in session because they can do things and spook the market. But basically, when they're out of session, on average, it does much better. And that's how he runs his fund.
That's great.
It's true.
Let me see if I have any other questions. General question, I got that out of the way. Anybody questions in the room, by the way? Anybody? I
have one question for Rob.
We have a great resource here. Sorry about that, guys. I just want to let everyone know that we have a great resource here, and we're very lucky to have this. And it's it's 1 o'clock. We've got some time, I guess. But if anybody has any questions, and you can't get to the chat room to just email dtrs@daytradingradio.com. And I'll find it and I'll get it out there real fast. But let's get them in there. All right.
Let me ask one quick question.
Yeah, go ahead.
For Rob. Basically, over his years, his experience, because I've been paying a lot of attention to time of day and where I try and take my entries and, how I feel about the last hour and this and that. Let me ask Rob, how he feels about, looking at the clock and his trading.
Well, nowadays, most of our proprietary trading is done in the over-the-counter market because it's still a manual market. So I'm not really a technical trader from that perspective. When we're trading, basically what we look for is it's pretty simple. We look for anything out of the ordinary. It could be volume, it could be price, it could be price and volume, and we usually let that be the predicator of how we trade. And it's not based on time. It's based on I'm sure you guys can use filters on these, like we have filters. Like if the volume gets higher than the 52, then it's the highest volume for the year at a certain period of time in the day. If it's
it's funny if you look at most volume profiles. The first hour has a lot of volume, then it tapers off, and then lunch. We all know that's quieter, and then it ramps up at the end of the day.
Mm-hmm.
So a buddy of mine, we actually went through the easy language coding thing, and we actually wrote a code that would allow us to look at today's volume at, let's say, 11 o'clock compared to the last 10 days volume at 11 o'clock, which took us a little while to write. It wasn't that easy, but basically it allows us to intraday look at, compare volume. And I kind of use that as my guide to say, well, this is an active day or it's not an active day. It's based on the T-vol, which is the total S&P volume.
Well, yeah. Rob, you were mentioning
I'm a little off subject. Sorry.
No, that's good because I mean, he was mentioning his filters on volume. I would like to hear what his main, like you said, you're not really a technical trader, but you do follow the volume, and you mentioned some filters. What filters do you like to use? I mean, just kind of, you were mentioning something about the volume being greater at the time of day.
Well, it's not really time of day, but we look for. I mean, it's simple. We look for if it's a high volume for the year,
high volume for
a certain period of time. Like sometimes the stock will trade a higher volume than it has all year by like 10:30. So obviously that's a filter. Sometimes, like you're saying, Liberty this morning.
Yeah.
If you have a volume filter on Liberty, and I don't know what it is because I don't.
All right.
Let's just say it never trades pre-market. 2,000 shares go off pre-market. It could be, it would be something you'd look at. Now, if I saw a filter that says, let's just keep it simple, Liberty never trades pre-market and 2,000 shares go up, so the volume's up 100%, or because it never trades, I would not trade off that because it was a small trade. However, if you look at Liberty and you say, some days the average trading pre-market's 5,000 and now it's traded 50, then obviously that's a trigger. I mean, it's the same triggers that you guys probably use on your.
I'm going to go back to original. There was a question I mentioned before, and I don't know if we really got I mean, I don't think there's an answer to it, but from your experience in the markets and working behind the scenes in a way, and of all your experience and stuff, and if you could put a filter on everything that you've learned, what has really stuck with you, and what would you pass on to like some of the listeners today that is important? When you follow the market, when you trade the market, what is your number one go-to indicator? What is something that kind of keeps you trading every day? Like, because you don't want to be in a random market and you're guessing every single day, but there's got to be some reason why you're involved in the market. For me, I follow momentum, I follow charts, I look for the combination of things lining up. But I'm always willing to, try to find out, like someone from you who, the back end, is there anything out there a key thing that you could just pass on to people and saying, all right, from my experience in the last 20 years being a market maker, pay attention to this. This is important.
When you were talking about momentum, and it depends on your strategy too, right? So, you were talking about momentum. You're talking about, ups and downs, volume increases, decreases. I mean, the only thing I can tell you is now, everyone is trading at such a different level than they have before. Like I said, you guys have better tools than a lot of the professionals are equal to. What we used to always say when we were trading is that we were just what kept us in business for so long was just discipline.
Yeah.
I mean, I know that's
great. Right there.
That's just the thing. Don't be afraid to take a loss.
It comes down to that. It does come down to the discipline in your trade. It doesn't matter what style you're doing as long as you have discipline, and it's and you could what's the best? And I'm going all over the place with you, Rob, but
that's your style, John.
That's my style.
Like we all have ADD.
Yeah.
Okay. Yeah. Let's admit it.
If you were to put an analogy to your market, like an analogy, I always say the market's like kind of like gambling. You want to bet when you have the best hand, when the things are setting up the best. Do you have an analogy for the market? I could. You're down in Florida, right?
Yeah.
You're down in Florida. Your neighbors from Jim. You ride around in a golf cart, I hear.
Yeah. Every now and then we wave at each other.
I hate people with golf carts.
Well, you'd hate us then.
I can just imagine these guys zipping around their town in golf carts.
Hey, there's no DUIs ever handed out, coming from the clubhouse to your house, so.
Yeah. So, I'm sorry. Again, what?
I don't know where I was going with that. I think I just left it off and we lost it.
Let me paraphrase.
Yeah.
Tell us the most important thing you know about the markets.
Yeah, tell us something. That tell us your.
I mean, I can only
give us the answer, oh guru.
I just think that with the markets, you have to be humble. Sometimes the best trades are the trades you don't make. Just people that.
Yeah, waiting is a strategy.
you see it all the time, and I've done it too. And you learn from experience. You see trades that you know are right, but they just don't work out for you.
Yeah.
You just got to know when to just
Discipline.
realize
Yeah.
You know, like the market being a short. How many people think the market's a short right now?
Yeah.
You know, a lot of people, right?
A lot
So,
of people.
Are they? You know, they're not winning. It's not saying they won't eventually win, but sometimes you have to realize that that you're wrong, and it's hard to do because sometimes everything sets up for a perfect trade, but it doesn't move the way you want it to, and it doesn't make sense. But the markets don't always make sense, and that's the thing.
Yeah. Have you looked at Gas's Gas Bot? He's been you know, he has this automated trading
He doesn't
system.
know about that.
Well, you should introduce him to that, Gas.
He's trading more size. He's trading pretty good size over here.
No, he is. He's
Don't even mention it.
Don't mention it. All right. Well.
But actually, John, I'll touch on that for a minute. And
Yeah.
A couple people have said, "Hey, gee, what happened to the gas spot?" Well, both FT71 and Dan Riley said, one of the hardest things to do with futures is to trade a single car.
Mm-hmm.
And I actually found that to be true. I mean, it's much easier to have repair trades and trade a little more size and scale out, on your exits. I mean, one car became very difficult. And that's kind of one of the reasons I shut the thing down. It was, one, it was taking a lot of my time. And two, it was a one-car strategy, which is probably the hardest way to trade futures.
I agree. And it's hard to trade stocks that way too. When you think of one contract as being your first, as your
first and only position.
Right. So the same thing works. You need to be able to scale in and repair trades and adjust your trades because you're normally going to be in the right area. Right. Most likely, if you have the patience and discipline in the stock or the futures pull back into let's say buy side, we're on a buy side example right now, but you get something that pulled back and you feel very good about it. You've taken a lot of risk out of the stock, but you might get in. But you get in with your full load there, and you have no wiggle room.
Your full load is one car.
Yeah, and your full load is one
neuter,
car.
Right?
You're stuck. You just can't do anything. But you're kind of confined to that rule because you can't change the rules in the middle of the game, especially with a trading bot. I understand. So once you're able to identify what works, and that's the same thing again with stocks. Instead of taking a big position, it's much easier to get into a smaller position, kind of adjust it, build it up, protect it, manage it, and then profit from it.
One of the great entries I like in our trading room is they say first position, and it is X number of shares. Well, what that says to you is, if the stock goes forward, in my direction, I'm happy, right? If I haven't taken my full position and it goes against me, I'm still happy because now I can buy it cheaper.
Yeah. But when you're in a situation like when you had the gas spot, again, the situation I'm in, you take a position and say, well, I want to adjust, and you're not, where I could take a small amount of shares, someone's actually loading up the boat, and then they was like, wait a second, I don't want it to pull back. But you have to realize that, this is a game of, of an area. It's not a horseshoes and hand. Well, it is horseshoes and hand grenades. It counts if you get close to it, but it's not going to be perfect. Anyway, any more questions? Let me see. I know J-Dub was asking about the VWAP before, and you mentioned on the TWAP. But do you have any?
Sometimes it seems like the closing print often goes off around the VWAP. Is there any logic to that, Rob?
It's just a coincidence. If the closing print was always the VWAP, it's just a coincidence. That happened.
Okay.
So. Yeah, I mean, there's no way there would be no way to gauge that.
So I see on my time in sales a burst basket sometimes, and I asked Rob about it, minutes before we actually came on air. And did you learn anything? He was actually Googling it.
I didn't know.
Well, where'd you get the term burst basket?
That's what shows up on my trade station time in sales.
Okay, all right. So I don't know that.
See, different systems have different monikers, and I don't know why, but like burst basket is what we read about it was it's just part of a basket of orders with different stocks. So I guess that's letting you know that whoever bought or sold that stock was also buying and selling a basket of up to 50 stocks. I don't know what other stocks it would be, but
that's interesting. So somebody says, all right, I want to buy this lot of of 20 stocks, and that's part of the burst basket.
I know what a basket is. The first time I saw burst baskets when I came here today. I don't know.
All right.
Yeah,
fair enough.
I never heard of that either. We have a question from Paulius. Hello, I'd like to suggest a question for the market maker for tomorrow's interview. Now, this question, I'm trying to read into it a little, but it might be a hard question to kind of figure out. But if you want to comment on it, any advice on shakeout versus true movement in stock? For example, at the open or after a big move in previous day or previous time frame. All right, so let me kind of do my own way of clarifying. Early morning trade, the first hour of the trade, maybe the first half an hour of trade. Do you ever see, how does the market makers, that's probably one of the busiest times of the day. Is there a technique that you guys see being applied in the first half an hour, 40 minutes, 50 minutes, first hour of the trade where you normally see a fade of the first move? Or is there anything like that? The first move is usually faded. Is there a lot of volume in the beginning? How do you trade the opening hour?
I mean, whenever someone's trading the opening, you always have to look if there's a big gap.
Yeah.
That the stock will fill the gap. So, I mean, obviously, if the stock spikes up on the opening, you always have to be, and it's trading, and it's trading vertical. For a certain period of time, you always have to be prepared for the stock to come back in if you're buying. So yeah, I mean, the thing is with that is that there's nothing that we see that you don't see.
Yeah.
So that's just a technical barometer. But if you have an indication out there that a stock looks overbought, that's usually a time to get out for the short term.
Yeah.
But
so basically, what we're getting here is that market makers don't really have a big advantage over the retail traders. I mean, if they go out on their own. I mean, that's where I was trying to get, if there was a connection between what experience you have from your work that you could actually carry over to a trading career or some other kind of career, maybe even something that, I forget the word I'm looking for, but an advisor or something. But basically everyone's on pretty much an even playing field, and the algorithms, I mean, how do they have an advantage? Do the algorithms now with the high frequency trading, is that, what's
I look at algorithms and like I said before, algorithms is a broad term. I'm sure high frequency traders use an algorithm to trade with, but when I look at an algorithm, I look at it as like pretty much neutral, working for someone working for an institution or someone trying to get an entry point into the market or an exit point out of the market, and trying to get them the best price with minimal impact. And they use all kinds of parameters on it that they may want to use, and that's how I look at algorithms, really. So I don't think algorithms really affect the market. It's just more and more orders are not being shown.
Yeah.
So that was what the market makers used to have as a hedge, is that they would see books, or it would be on your book. Like I said before, you knew years ago, if you had buy orders all the way down your book, you were pretty safe being long the stock because you were stopped out. If the stock started coming in, you could execute the buy orders on the book. The specialists used to trade like that too, but now with automation, you're not seeing that order flow. So that's a strategy of trading that has kind of gone away, and the people that are proprietary trading now are trading, on market making desks, and they're using technicals like you're using, entry points, exit points, volume, things like that. So,
well, let me ask you this, Rob: is there an advantage to quote hiding your order? I mean, or is that just
when I say hiding, I say that they're using, if they're using an algorithm. If an algorithm's executing, 100 shares every 5 minutes, and it's a 100,000 share order, then there's an advantage to doing that. And where the algorithms have taken the place of traders is that they can actually do that. It's hard to get a trader to manually do that throughout the day especially if they're trading more than one stock. So,
well, I asked actually a guy that was a professional money manager, about stops and whether the market sees your stops. He says, yeah, they see your stop, and they also know there's hundreds more there too. So, they run to your stop, but they also run to everybody else's. So, they know they can push things around.
Yeah.
So, don't be so naive to think you're the only guy with a stop. At some certain level, there's hundreds more.
Yep.
Nice. Well, I'm actually happy. I'm happy that you guys don't have the advantage. I'm happy that, in some cases it's not a rigged market. That's what I'm getting from you, Robert. That it's not a hopeless rigged market where, the individual retail trader is doomed to succeed against the algorithms and the high-frequency traders.
And I think at certain times the retail traders actually
do
costs
better.
them actually less to execute than the professionals.
You know what? What I'm hearing from you is day trading radio is probably the best place to be.
John, 1 cent per per share.
Got that in.
Low tick alert.
100 shares or more.
Yeah.
How do you beat that?
No, I always said, what I like to do is, try to be that manual, manual machine, that automated machine that has the discipline, the algorithms and stuff. Take out that human emotion, of the trade and stuff. But yet, what we have is intuition that we add to it, and we also have experience and stuff, and we also have, our own discipline and understanding. I'm happy. I'm happy with the interview. I'm happy that you don't have the edge, Robert.
Yeah, that's definitely evened out. So and I would just say too that algorithms, serve a specific purpose usually for people to trade with.
Yeah.
For a strategy. So yeah, I mean with everything going on, in the market, it's definitely going in the direction more and more where it's an even playing field for the people outside in the market and inside the market.
Well, you've been around 99. That's when 96. That's exactly when I started trading full time in 1996. So we have that in common.
Right.
That's really a cool thing. And I don't know, maybe a lot of people had that in common. It seems like a lot of people, I started getting interested. My first trade was the original AOL. And then I quit my job in 96 and I started trading in 96. And we went through, the great tech bubble, and we went through everything, 9/11 and stuff. And we come out of that, and we see how the market has evolved. The pattern day trading rule, the fractions that disappeared, the SOS bandits, everything that's come and gone. Kind of maybe, and I welcome you to stay on as long as you guys want. But if my final question to you is, where do you see the market in 10 years? Where do you see the market in 10 years? Is the market going to pick up? I mean, we keep on hearing the volume is like the action is not here in the market. I don't mind it as much, but I'm still feeling it. I'm feeling the lack of excitement, no longer the big reactions on the Fed moves. Things have really kind of gotten like shock therapy and just died out. The big reactions, the big moves and stuff, things have really quieted down. The VIX has dropped. What's going to happen in 10 years? Is the VIX going to be at 2?
I have no idea. I have no idea, man. There's classic people that say the Dow will be at 5,000.
Yeah.
And
of course.
You hear all these analogies of the gold will be more than the Dow. And all these things. And the reality is no one knows. But if you're asking me what I think the market's going to be like, like for professionals.
Yes.
I'll see on my end. You'll see more and more. You'll see less and less people doing what we're doing. It's been like that over years. There had been dips before. There was a dip in '99. And then it picked up in 2002. There was a dip in '07, and it picked up again in 10. But the last few years, it's been slowly dwindling. And I think with the automation of markets, it's definitely taking more humans out of it. And then it's also putting more power in people like yourself, like you and Jim, that can sit there and trade and actually compete with the professionals and actually make money for yourself. So I think that segment of the business is really increasing. I think a lot of these chat rooms where these people are sharing ideas, because there's a lot of ex-traders in them now. There's a lot of ex-professionals in them, and there's also some people.
Most definitely, we have a lot of professionals now that have gone on their own, and they show up in our rooms and they talk about my days on the floor, and
we have a lot of
Epic comes to mind, right?
Yeah. Great. And Rob, as a great segue, I'd like to, kind of give you the honorary member of Day Trading Radio. So I want to set you up as a member, so you have free access to the room. And
let me ask Rob a question, which I think
we need all the market makers we could get in this room.
But listen, let's talk about leveraged ETFs, because I know Rob at one point had a strategy going where he shorted both because they lose money. Every ETF lost money the first year or something.
This is going back years. When the leverage ETFs first came out, we would short the long and the short, because once they had hit a price, once they had gone down a certain amount, there's no way for them to get back to the higher price. That's why a lot of them reverse.
Well,
I haven't traded them in a couple years since.
When you say
So
reverse, you mean split.
reverse split, yeah.
Reverse split, yeah.
Yeah, reverse
But
split.
so would you do the same thing? I mean, when VIX gets down here a little bit more, or any of these, these leverage ETFs get back down towards those levels that they reverse split, is that strategy still available? I mean, it seems. Go ahead.
I'm sorry, we didn't trade them off the VIX. What we traded them off was when we had this thing, we had something on we were using on Bloomberg that showed dollar amount in and dollar amount out of ETFs, which I think you can still get, and that was giving us the indications of how we should trade them, and that's what we were going off of. We never really traded them due to the VIX. We just looked at the dollar amount going in and the dollar amount going out, because ETFs are shares that are created by taking the baskets of stocks that they're in. And if they're leveraged, then there's derivatives involved too, and it's complicated. We don't really know exactly how that works, but we knew that there was more money going in and there was more money coming out of them. So we would use that to trade with. That's going back. I forgot. You remember that?
I do.
It took a while, but we made money on the short and the long, on shorting the short and shorting the long. So, but the trade ended up taking 6 months. And we thought it was going to be a lot quicker than that. So, and that's the thing with trading too. You got to understand is that sometimes it's not about being right; it's about being right at the right time.
It's about patience.
Yeah. So.
Patience, discipline, yes, teamwork, yes.
All right, well, Rob, I certainly owe you a beverage of your choice.
Oh God, let me come down for that.
Cool. Thanks for having me, guys.
Hey, Rob. I'm serious about the invite. I'll send you some information through Gas, and great segment. And I appreciate all your knowledge, and thanks for coming by and just spending some time with us.
No problem.
And
thank you for having me.
Yeah, anytime. It was a great interview. Really appreciate it. Again, take your golf cart. Have some fun today.
I will. Well, thank you very much. Good luck, guys. Good luck trading.
Thanks, John.
Hey, Gas, thanks.
Rockstar and all.
Jim Frazier, thank you very much. Thanks so much, buddy. I'll talk to you later.
Is this going to be recorded?
I'm recording it. I recorded the whole thing, and I'm gonna lock it up and send it out.
All right, perfect, buddy.
All right, thanks again. Take care, guys. Thanks, all right, there we go. Nice interview. No recording. No recording. Let me stop this right now. I'll save it. I'll save it for another recording. I'm going to stop this. I'm going to stop. It was about an hour, I still have half a sandwich here. It was hard to get a bite in. Every so often you probably hear my mic turned down. I was taking a bite of a sandwich, but I have a half of cold sandwich here, a steak sandwich. But it was worth it. He's a very well-spoken guy. You know what? What I got from that is day trading radio is probably one of the best things out there. Honestly, I mean, there's no advantage. I don't think. Was there any big secrets? No. What do we learn? Maybe that there is no big advantage in the market to people. Behind the scenes, algorithms are not all that they claim to be, and. We'll go with our percentage win, which stays above 70% each month. I'm thinking that's pretty good. And we get to pros to become members here at Day Trading Radio. All right, let me hit you up with a tune. Well, actually, am I off here? Did I turn it off yet? I didn't turn it off yet. Let me turn it off, save it. We're going to come back, restart it, and pick up the markers where we're at. All right, be right back.